the question here is, given the stuff we do on literacy, different ways of measuring literacy and so forth, and we do it, and we try to have a policy intervention for that, but does it lead to inclusion in general? So the idea is to look at, the questionnaire is very rich in that way, that can you hear me? I usually teach a class of 250 people, so you should be able to get it from me. So as I was saying, so whether literacy actually includes to awareness and inclusion, that's the subject of the paper. One of the good things about the data we receive, that we have various categories of financial products we use, and Dr. Agarwal looked at one of them. In a sense, I'm kind of looking on everything together. So there are differences in categories of the product, but yeah, we'll go through so the point again, the point about here is, what is financial literacy? Now I have heard a lot of definitions here. You know, my feeling of financial literacy is the ability to understand how money works in the world. That's probably the most simplest definitions you can think of. You know, you can talk about risk, return, etc. But ultimately, is the understanding of how money works. First of all, what is money in that case? Money is basically claims. So you do something and you got a 10-pound note or a 10-rupee note, and it's a claim towards your future consumption. You will consume it with your money you just earned. So the two components of financial literacy is, first of all, finance. So the point about any well-being is, what is finance in some sense? The finance is actually helps us to smooth consumption. So I have money now. I have to live for 50 years. How do I smooth my consumption? I have got risk on the way, etc. So the consumption smoothing is the main function of. And in a sense, the survey actually looks at the consumption part of it, that how to smoothing this consumption using these various products which helps us to do this. You know, for example, Professor Agarwal said, look, the farmers buy the insurance because they have these fluctuations of their income. Sometimes income goes up and down, but if you have an insurance, you basically smooth, so you get that money in case your crops fail, and that's why you want to smooth things up. So the other issue which came up in the preliminary talk was about income, which we never touched, is that, and that's why it's kind of a halfway. I would have liked to have another bullet point here, is to have the income part of it. So you can only smooth your consumption if you have, ultimately your consumption must relate to your income and they match together. So unless your income goes up, you can't consume more. So that's fundamental. So given that, we only talk about smoothing consumption. Now, OECD and START people have started talking about this in a few years, 10 years ago or something, Professor Lisali. But I mean, there is an Indian context of looking at consumption smoothing. So you probably would have known that India has three philosophical strands. One of them is materialism. So this goes back to, so this is 1,000 years old, Yavat janam sukham jivet vinam kritam kritam privet. So this guy is saying you are in your lifetime, if you want to feel happy, even you have to borrow to eat ghee. In other sense, debt is not a big issue. Debt is only an issue if your income goes down, right? So, and that has been there in Indian philosophy for like 1,000 years. So, in a sense, financial inclusion or financial literacy doesn't necessarily mean that you don't go into indebtedness. Indebtedness is not a bad thing as long as you can pay back, right? So, if we tell people that you don't go into debt, you are actually reducing the level of consumption, which is basically bad. So given that, why would somebody buy a product which doesn't help them to maximize their consumption? So starting from that, does financial literacy actually helps into forcing people to buy products which they are interested or not? I sometimes feel, it's not we, it's probably I, sometimes feel we don't give people an agency. The poor has an agency. The poor knows what they want to do. The middle class knows what they want to do. So the question is, does this financial literacy actually helps them to know what they do, or just makes them, giving them an opportunity to what they do? So therefore there are two parts of it. So there is an awareness and we call it the ownership. So the idea of that is the intervention part. So we are talking about the intervention part. The intervention is financial literacy, of which I would rather say, we heard that there are three parts of it: awareness, knowledge, and behavior, of which a person, you can intervene in your knowledge sphere, but attitude and behavior are mostly ingrained. You can still change by introducing a shock or something. So for example, this demonetization shock will probably change people's behavior, which you cannot educate people. Okay. So, and most of the time when I say literacy in terms of policy intervention, it's probably be knowledge. So the idea is, and this is the nicely designed part of the questionnaire was that I could write this down like this, that intervention which gives you awareness and unawareness. So even if you are financially literate, you can be aware of a product or you can be unaware of a product. Of course, if you are unaware of a product, then you of course are not included, almost by definition. But if you have ownership, then when you are aware of a product, you have to have a decision. So this has to be ownership. Okay, one is the ownership and another is the non-ownership. So whether you buy the product or not, that depends on your necessity, right? So I just bought a house insurance, but I would not buy a house insurance if I didn't have a house, right? Even though I might know there is house insurance. So does that mean if I don't have a house, I don't buy a house insurance? It is necessary that I am financially, not included? Maybe not. So there are other things in the equation from here to here which will make somebody own a product or not own a product. So again, one of the nice things about the data was that we had these 25 products and we create an index out of these products and you have 4 classes. So the result was that what we did was divide the products into 4 different parts. So we had a banking product, which is kind of the main savings, fixed deposits, etc. The capital market product, insurance and pension. We had the futures as well, so 5 of them, but I kind of decided to throw them away because there were so few of people who actually buy futures. I mean, before I started working in finance, I didn't even know what was futures. So I guess that kind of explains. One of the things we found, that financial knowledge, the FK statistic Dennis just talked about, and financial literacy, which include all these 3 things together, has a very strong relationship with this set of products which we create as an index. The idea of the creation of the index is very similar to the way we created the literacy index, by weighing against the general population holding of these products. So the result more or less was that financial literacy or financial knowledge actually helps in creating awareness, and of course inclusion, because inclusion capture is part of awareness, like simple stuff. But when we see whether the ownership, actual ownership of the product, then we find that there is no relationship between financial knowledge or financial so that's the thing. So, and then we also did some analysis on how to rank different products on the level of financial knowledge. So we decided to create a threshold upon which people are more inclined to buy a certain product or less than. So we have ranked different products in this So the idea is that, the final idea is that the interpretation of this result in one line would be, well, 2 lines. There are 2 interpretations of this result. One is that, there is a saying in English, you can take the horse to the water, but you cannot make him drink. So the idea is that you can make people aware by introducing financial knowledge, but you cannot force him to take the decision to buy the product. Okay, I'll leave the last sentence in the line. Because otherwise I would have to stop talking now. So we had a drink break. I was saying, so that's the idea, that the ownership is a part of awareness, and that's what I'm going to show. So a couple of quick pictures to show this. So this is a basic raw data on awareness and ownership. So the blue line is basically the ownership data. So the guys who are aware, of course, and the amount of people who are ownership is there. So as you can see, the savings bank accounts is pretty big, and the ownership structure is also good. So in a sense, it looks like that 50% people who are aware, they own a savings account. So that's around 92% of people who are aware, and that's around 8% who are who have a bank account is among the sample. So, and if the survey has been done the pre-Jan Dhan era, then it's probably even more now. So it's probably a 100% coverage rate already. So, and of course, loans, you are aware, and this is very interesting because not many people seems to know take much loan. The credit card and general credit card. So people seems to have have forgotten Charbak and they don't take loans that much. Or they have loans from other places. So that's the banking scheme. So in terms of insurance, this is what Professor Agarwal said about cattle and livestock insurance. And that's kind of minuscule. That's what it came out to be in your case as well. Well, it has to be because there's like crop insurance and livestock insurance. So both of them are pretty low. Among the insurance class, of course, the life insurance is pretty high, and as you can see, the ownership structure is almost 50%. So, but life insurance in India, we kind of know that it's not really an insurance. So unless you die in 5 years, it's not really an insurance, it's more like a savings scheme. So again, this is mostly a savings scheme. Motor insurance is high, and essentially because again, you have to have a motor insurance. Health insurance is also quite significant. So in terms of capital markets, which is no wonder that the awareness, bonds, debentures, mutual funds, IPOs and stocks, very few people have any idea of what they are. And maybe stocks, it is true, but again, ownership of this kind of equity-based instruments to save your money is also not there. So money you can either save in terms of bonds or equity. So this is the equity, and the other figures I showed is mostly on bonds, savings accounts and recurring deposits and so forth. So this basically probably shows the risk averseness of people. So the general population seems to be either risk averse, but in some of the cases they're not even aware of there is a possibility to take risk and maybe the returns are higher. So we don't really know what the risk return ratios are in these cases. So pension is another, this is an obvious income smoothing thing which you can, you defer your income till you get old, and that seems to again have quite a high intake in kind of space. This the EPF has quite a high intake. So basically, the idea is to show these 4 different types of the classifications, which is there, and try to see which one of them is actually affected by financial literacy. So we have these usual control variables. So we have effects on regions, but well, we could have done it with states. I think somebody mentioned that the fixed effects should be states. But one of the problems of using refined fixed effects, is that you overfit the data. If you overfit the data, you get a very high R square, but very little effect on the other variables. So this is, me statistician saying, but so that's the idea. You have to be balancing between your fixed effects. So just a quick aside. So this is the awareness results. So the first line, I'm not showing the results on the controls, forget about it. So the first line is the index, the financial literacy index Dennis described, and this is the financial knowledge index Dennis described. And these are the financial literacy index of OECD, and this is the financial knowledge of OECD, which is just the average. So it's just we are mostly interested in these 2, but we put them to check whether we are quite well off or not. So one of the obvious thing is to see that financial literacy affects the banking sector significantly. Financial literacy affects the insurance industry significantly and the pension significantly. What it doesn't affect is the capital markets. And you can see the most of the cases, with exceptions of the OECD controls, they are pretty insignificant. So So my feeling about this result in case of awareness is that the way we calculate financial knowledge and financial literacy are not really capturing the level of sophistication somebody wants to use when they are looking at consumer capital markets. So you probably need a different level of financial education to capture the effectiveness of financial knowledge on capital markets. And that's, from the Indian context, is very true, because most of the time the returns you get on your bonds, in savings accounts or fixed accounts and etc., have a real interest rates of negative. So in that case you are actually losing money in case if you put in bonds. So you actually have to encourage people to take into risk taking, especially when the interest rate regime is going lower and lower these days, and worldwide as well. So that's one of the things. So similarly, if you look at the same idea, now we look at the guys who actually own the product, and again what we find is that throughout the entire different controls, different variables which looks at financial literacy and financial knowledge, that none of them gives you any significant results. So that is what I was saying before. So ownership, however you measure literacy and knowledge, it has very, very little effect on ownership. So in a part, what is happening is the knowledge actually pushes you towards awareness, and then once you are aware, you are not necessarily buying anything. Now, this is very interesting in terms of a research question, because most of the research has been done in the global area is on inclusion, which is this one. And if you look at the inclusion, which is ownership plus awareness, you get significant effects on at least the insurance case. If you look at insurance and pension, these are quite significant. And the overall test, as you can see, that these are also significant. And that is what worldwide the literature actually shows, that inclusion has a positive effect. Financial knowledge has a positive effect on inclusion. And what is the thing, that the richness of this data actually made us to split these two parts, awareness and ownership. So what in most cases probably is the same thing, is that people are catching what is inclusion is actually they are catching awareness. Because we could split the data into two parts, the activities into two parts, we could say that actually it doesn't really help in inclusion, though this is the false regression. This is the false data, is the false interpretation of saying that financial knowledge leads to inclusion. But what it leads to is awareness, and then to inclusion is a big gap. So this is kind of the main conclusion of this result, and that it helps you to think of why this is so. So, and as I said, this is one of the result is that, look, it might be the case that these guys, you can only take somebody to the water but not making drink, and that's what is coming up. So given that, what I try to look at is what happens when, okay, never mind. But then what we do is to look at, just simply looking at financial knowledge and financial literacy, and see which of the products, individual products, are affected by financial knowledge or financial literacy. And you can see there's a huge lot of complex products which has where financial knowledge has no effect. This is just a regression. This is a kind of a probit model between financial knowledge and the products themselves. That's the awareness of the products. Now, but similarly, you can get the same stuff if you just use financial literacy, and these products have no relationship with financial literacy. Quite a big amount. Now, what is interesting is then what we do is that look at the guys who have some relationship with financial knowledge, and then we rank them. So how do we rank them? So we rank them in the fact that we create a threshold, so that Fk star is like a threshold. So the idea of a threshold is that this is the point where you will take a 50-50 chance of being aware of the product or not. So if you are above the threshold, that means you are aware of the product. So that's the 50. This is, and it looks like, and something which comes up, Professor Agarwal's, that crop insurance seems to people are aware of, literally very aware of things, but that comes quite low down the list. General credit card and savings bank account, these are quite high up the list. Public provident fund, cattle and livestock insurance comes up as a very high awareness. Employee provident fund, surprising is the IPO and the mutual fund. So up to 1 to 6, it seems these are the things which is kind of given to you, just generally to you. So you don't really need, of course, if you are probably if you are a farmer, you are more likely to know about cattle and crop. But so there are these 8 products which are kind of affected by financial knowledge directly. Similarly, you can do the same thing for financial literacy, which is of course include awareness and other things, which have these other products. Which is, again, credit card seems to be literacy as very interesting that it comes up at the top, that financial literate persons is at a very high threshold of getting aware about credit card. So 2 points about this. So what I don't want to kind of completely dismiss the idea that we cannot explain ownership. So what I did was looking at ownership, the conditional probability of ownership given awareness, and that seems to be, so if you're kind of crossing towards 50%, that the more aware people seems to like and more likely to own the products. But in general, it doesn't seem to be the ones that financial knowledge or financial literacy is not the one which drives them towards buying the product. So as you can see, quite well, these are pretty low. The conditional products are low, but most of them, quite a few of them are near the 50% range. So there is something else going on which drives ownership. So again, the savings bank account is kind of so all these results point to this interpretation. As the first one I said, that you can lead a horse to the water, but you cannot make him drink. So that's one interpretation. The other interpretation from straightforward, that kind of probability chart, is that because you are financially literate, you might be aware, and you are aware that somebody else is conning you. So they are giving you a product which is not really fit for purpose, what you want to buy, right? So actually the negative result might be a positive one, because it is the sellers, you are not selling the products you want, and that's why you are not buying it. From the all throughout, we seems to have this idea that whatever the banks or the insurance company shows you, these are the best products, right? But now you are aware, you are literate. You might think, really, I don't want them. The guys, so these are the guys who are buying it. Oh, sorry. So these are the guys who are buying the insurance products. As you can see, life insurance is around 50%. As I said, it's not even an insurance. So they are buying. So the guys who are buying it might be buying it and they are not even aware of what they are buying. So the awareness actually creates a market for consumer empowerment. And that's why they are not buying it. So we cannot do this analysis in terms of a partial framework where you are thinking, the supply side is okay, but the demand side is the problem, so I have to fix the demand side. But the demand side seems to make a lot of sense at an awareness stage, and then this guy says, I don't want it. And that is the main point. Yeah, I didn't want to end it at a negative but that's what the data says. Thank you.
You've removed the enthusiasm from financial literacy and awareness. So,
this is Pooja again. In fact, removing, I would say it has motivated me more, because when you say financial literacy in schools, what should be the motive behind it? Because the students won't be having access to these things. They can't access, after a certain age only they can access the saving account. They cannot invest somewhere. But what should be the motive behind teaching them in schools what is financial literacy is to make good financial decisions when they have to make it. So we are preparing for the futures, as sir said, that it might be like making them aware what not to do. Instead of just telling what to do, it's like having your own empowerment of what you can do. So I really liked sir's presentation. It's quite motivating. Thank you, sir.
Thank you very much.
any other question? No, you're very right to a certain extent that this is an effort which NISM is also doing, that if we are able to go through one generation of school children, then we'll have a financially literate India. Of course, it doesn't spell very good for the banking sector, because people will then stop keeping money in the bank. Because as a mindset, we keep money in the bank, not knowing what it is supposed to be doing. 90% of the people keep money in the bank for liquidity, for safety, and for transacting business. Now, these 3 points are very good, but they also keep money in the bank that money grows in the bank. And that illusion has to go, that money doesn't grow in the bank, and this we cannot teach to the current generation who are familiar to Muhammad of Ghazni, because Muhammad of Ghazni came to India 25 times. We did not even change the temple. We kept the gold in the same Somnath temple so that he could come and take it away from that temple. So I think that is the phenomena, that one round of school education will give us where we have to invest if we are wanting to. Why do we want to buy? We keep on talking about life insurance, and people from IRDA are sitting here, but I would say that actually the debate was that should we call it death insurance? Because it is actually not life insurance. But if you call it death insurance, who will buy it? So you called it life insurance. It doesn't insure life, it actually insures death. And if we say that if we are able to educate the current generation that it insures death, then possibly they would go in for a term policy at the age of 23, 24 for 1 crore of rupee by paying nominally 25 or 30 rupees a day. And I think that is the education which the school children require, which I am unable to teach because the neighbor always I always feel that something will happen to the neighbor, not to me. So he is supposed to take the insurance. So thank you very much, Professor Banerjee, and let me give you a small token. I have taken an executive decision, and I hope you will abide or follow it. We just completed lunch. If it is all right, we go to the policy roundtable and then have tea, rather than again break for tea and then again take 35-40 minutes to assemble back. It's all right? Okay. So I've been asked to moderate the session, and we have big guns from all the 4 regulators. We have Mr. Udgata, Principal Chief General Manager of Reserve Bank of India, please. We have Ms. Mamta Rohit, Chief General Manager from PFRDA, the pension regulator. We have Mr. Hariharan, the Chief of Communication. I'm saying the other words, please, because automatically anybody who is coming here is also looking after financial literacy and inclusion. And we have Mr. Pularao, Executive Director from IRDA. Please. And I think this session, I would speak less. They would also not speak much. But you are supposed to ask questions because the session was having a policy roundtable with all the 4 regulators who have played a significant part. In the Indian scenario, the regulators have played a very significant part. I would say regulators and government. 1969, when we launched nationalization of bank, that was one of the biggest exercise of bringing in people into some fold. Then priority sector, 40% of adjusted net bank credit. No country in the globe provides 40% adjusted net bank credit towards priority sector, which by and large goes for financial inclusion in a big way. And then the 101 schemes which keep on coming up, whether it is employment oriented, whether it is loan oriented, whether it is front subsidy, whether it is back subsidy, these loans, these products keep on coming up. But over and above these things, 2004 was a watershed year for financial inclusion, and the banking regulator launched something like, what was that? 2004, zero balance account, no frills account, which today is the Jan Dhan account, actually came up in 2004 as a no frill or a zero balance account. And again, the public sector banks went rampant, opened, everybody declared that I am 100%, I have 100% zero balance account and things like that. 2007, IFMR and CAB, College of Agriculture Banking, Pune, they jointly did research and found out that whichever district had claimed that they had 100% zero balance accounts, 99% of those accounts had never functioned. And that is the first point where it was felt that inclusion cannot be forced. You have to provide knowledge which will get converted into behavior or attitude over a period of time. And hence the drive for financial literacy started from 2007 in a big way. All the 4 regulators in their own way have been driving this force towards doing programs after programs. In fact, for the banking regulator, I can vouch that they celebrated their platinum jubilee, and they made it mandatory for the top management to identify 3 to 5 villages where they will spend at least a day every year for the next 3 to 4 years. And what happened was, it was a planned change. When the governor went to a village, automatically the roads, the banking structure over there, and what exactly was happening to agriculture and other issues came up in a big way, and many of them got addressed. This had to be stopped because then people started saying, why not my village? Why should governor go to X village and not to Y village? And that is why, but they went to the extent to do financial inclusion and literacy by spending time in the villages. I can say again for the banking regulator that they started their induction program. Their induction program for the middle management, it is now compulsory, and that portion of the time which they spend in a district, semi-urban or rural, is known as the rural immersion program, where they have to go to a particular district or a village and develop a plan for that place and support it during their period of staying in the organization. So this part I can talk about SEBI, I can talk about PFRDA, I can talk about our friend from IRDA. All of them are making exceptional efforts. But this policy debate which we did today as a part of the workshop following the survey which we did, the desire was to ask the regulators what is the way forward and what are the challenges we feel are there. So what I'm going to do is I'm going to let the regulators speak for 3 to 4 minutes each on what are the principal 3-4 challenges they feel they have in the area of taking this agenda of financial literacy and inclusion forward. And then we can have a couple of questions as to, or some solutions as to how these challenges, what is the way forward in these challenges which we are mentioning. So you want to start, Mamta?
Yeah. Good afternoon, everyone. I'm sorry, I think I'm a little late, and I'm extremely sorry that I have to leave early. I had absolutely no clue that this place is so far off, and now everybody is giving me goose pimple. They said you have to start early. You have to, ma'am, you have to leave by 4:30. So like, my panic button is already on, and but I really want to congratulate NISM on having this sprawling campus. I think very few organizations will have this kind of privilege. So congratulations. And thank you so much for inviting us over here. This is one area which is of a very, very prime importance to PFRDA, IRDA, SEBI and RBI. They are all deeply steeped into it and they have well-developed mechanisms. But we are in the development stage, and we have also started financial literacy in some nascent manner. We are facing a lot of challenges, as the director rightly pointed out. As you would know, PFRDA is promoting as well as regulating national pension system, which is the only pension scheme apart from whatever the employers offer you as a mandatory scheme. And besides the insurance, which is also coming out with some pension plans as an insurance scheme. And now the scheme is mandatory for all the civil servants who have joined the government after 1st January 2004. So in a way it is partly mandatory. Now financial literacy has different levels of challenge in PFRDA as we are dealing with different segments. One are the government officers themselves. And within the government officers, there are 4 levels, grade A, B, C and D. So whoever is familiar with the government structure would realize there is a lot of difference between the financial literacy or the literacy levels of grade A, grade C and grade D. And the number of subscribers in the grade A and B would be very less compared to the huge segment that is in C and D. So we are facing that challenge. Government has been on and off thinking of opening the investment choices. Right now they are under a default scheme, so they don't have to apply their minds which pension fund manager they are investing or which investment pattern they are going into, as it is all pre-decided. But if at all or whatever time the choices are open, we are going to face huge challenges. Now secondly, this was one segment. then national pension system is also applicable to any citizen of India. Anybody, you, me, anybody who is having an EPF account, anybody who is self-employed, anybody who is a businessman, spouse, children above 18 years, anybody can open. Now that is another segment where again there are some sub-segments. There are women, there are children, then there are self-employed, there are business people, there are chartered accountants, architects, you know, which are a different breed. So again, we have to address them separately. And again, you would all agree that people who are literate, they may not be financially literate. And I don't know whether it's a boon or a bane, but this product is pretty complicated in the sense there are too many choices. That is the thing we often hear, you know, and it is very difficult to decipher as to which is the right fit for the right segment. So that is again one challenge. Thirdly, PFRDA is administering Atal Pension Yojana, which is a scheme of the government, which is under a defined benefit scheme, unlike NPS, which is under a defined contribution scheme. I don't know whether would they know defined contribution and defined benefit? Okay. Now, defined benefit APY is generally for the downtrodden, underprivileged. So, although it is a very simplistic scheme with just a one-pager form to be filled with the bank, and it's only meant for account holders who already have a bank account, again, to address them,